We got to start off with the news. You're changing your S&P price targets for 3 months, 6 months, and also the next year. Let's do the 12-month horizon. 6,900, double-digit, about a 10, 11% rise from here. What is the catalyst? Right now, we're already at all-time highs.
That's right. And when we sent out this note to clients, the real message was, even though the S&P 500 has rallied by 25% over the last few months, even though the market's at all-time highs, we still think there's more gains ahead for equity investors.
All right. Let's go back. Even just for the year, we're showing it right now to the audience. You're the highest for the end of the year at 6,600 for the end of 2025. Quite a bit above some of your other peers. I'm looking at Wells Fargo, still at about 6,000. What is the biggest challenge to the market moving higher right now? We've seen tariffs shake up the market. Obviously, you know, the April lows were very clear that investors got nervous about tariffs. Now they seem to be shrugging them off. Are tariffs still an issue? And do we need to see the Fed cut to get to your price target for the end of this year? Again, 6,600.
Yeah, earnings are the most important driver for stocks. Last time we spoke, we were constructive on stocks, and that was because of the view that earnings would continue to drive the market higher. That hasn't changed. And for that reason, the key question now is how much will tariffs affect the earnings outlook? We're about to start that second quarter earnings season, and the key thing to be focused on for investors is what companies say about their ability to protect margins given these increased tariff rates.
We had a currency strategist on earlier. He believes that the weakness in the dollar is actually going to turn into a weakness for the equity market. The fact that people are rotating out of dollars means they're also going to rotate away from U.S. equities. Do you share that view?
That is a concern we hear from a lot of investors. But what's interesting is when I talk to those asset managers and CEOs who are considering what to do with their global asset allocations, what they tell me is they are still very confident in the outlook for U.S. stocks. And that's part of the reason when they rotate their portfolios, they're doing it through the currency instead of through the equity markets.
All right, let's get to your word of the day. It's resilient. Do investors need to be resilient? Is the economy more resilient than we thought it was going to be before?
Well, it's great to talk with you. It's especially great to talk with you on my favorite day of the week for markets, which is Thursday morning. And that's because at 8:30 New York time, we'll get those weekly jobless claims. It's the best high-frequency indicator, in my opinion, on the health of the labor market. And that also makes it really important for stocks. What's amazing this year is despite all of the political volatility, all the market volatility, almost every week we've continued to see a very resilient labor market. Our economists think, again this morning, we'll get another sign of that. And as long as the labor market remains resilient, the equity market should too.
I want to get to your pick. You didn't give us an exact pick. You got to follow the rules next time, Ben, but you said alternative asset managers, assuming you're talking about Ares, Apollo, Brookfield, Blackstone, et cetera. Why are you so bullish on those right now?
Yeah, we think this is a really interesting part of the market. And the bottom line is this is a group with high growth, improving prospects, and it really has not participated in this market rally. If you remember post-election about 6 months ago, there was a lot of enthusiasm about these stocks on the view that higher asset prices and more capital markets activity like IPOs and M&A would boost these stocks. And then, of course, all focus turned to tariffs. The market sold off. These companies fell with it. And what's incredible now is that thesis is coming to pass. The S&P is at a record. We're seeing more IPOs, and yet these stocks are still trading 20% below their prices earlier this year.
I'm going to ask you a double-sided question, but you got to make it quick on both sides. A lot of these alternative asset managers, they're trying to increase the amount of retail investors, accredited investors that are investing in alts. Is that a tailwind that's not priced into these stocks? And also for retail accredited investors, is this a good idea?
Don't have a strong view on whether that will happen. If it does happen, it's an unpriced tailwind. And of course, every investor has to make their own decision on a whole host of factors. We don't have the time to get into that right now.
Fair enough, fair enough. I also want to talk to you about NVIDIA very quickly. Kind of crossing that $4 trillion market cap, just kind of pulled back just a bit ago while we're on the show, kind of went up and pulled back. What does that say to you about the mega cap tech trade?
Yeah, something we talked about last time we were on together. The AI trade remains really strong. We heard it committed to last quarter in the earnings results. I think we're going to see that same commitment this coming quarter. As long as that trade continues, these stocks should continue to do well.